Hi everyone, I'm Mark Lichtenfeld, your Chief Income Strategist with the Oxford Club. Welcome to State of the Market. We're the most popular video channel at the Oxford Club, so thank you to all of you that have subscribed. And if you haven't, go ahead and click that subscribe button and you'll see why we're so popular. Now, I'm going to tell you about the biggest investing mistake I ever made. Now, every investor, and I mean every investor, and I don't care how successful, paid tuition at the beginning of their investing journey. And no, I'm not talking about getting an MBA at some fancy school, though many investors have done that. I'm talking about bonehead mistakes that cost investors money, but often serve as an important lesson. So let me tell you about mine in the hopes of saving you some money by not making the same mistake. As I mentioned in last week's video, during the dot-com boom, I was trading like crazy. So I bought this one stock, Quacka. It was garbage, and I knew it. It was a cool concept, though. It provided streaming video content for niche sports like kayaking, rock climbing, etc. But this was in 2000 when no one really had broadband, so they had an interesting concept, but not really much of a business. Now, the company did land a deal to broadcast some of these niche sports from the Olympics. So I bought 1,000 shares at $7.50, figuring that as the Olympics got close, there'd be buzz about Quacka's programming and the stock would fly. And I was absolutely right. Now, at the time, $7,500 was more money than I had ever put into a stock, and frankly, it was too much. It represented too high a percentage of my portfolio at that time. So the stock ripped higher, and when it doubled, I mentioned to my wife I was going to sell half of it and take our initial investment off the table. Now, she had dot-com fever like everyone else, and she thought we should hold on. Now, keep in mind, my wife does not work in investments or finance. She wasn't following the stock or the market like I was. And I explained that this was a speculative trade, and I'd sleep better at night if we sold half so that we were guaranteed not to lose anything. And if the stock does continue higher, we still participate in some upside. Now, understand, my wife is not a greedy person at all. She doesn't buy lots of stuff. She's not showy. Material possessions are not important to her. So I was surprised when she was pretty insistent that we hold on and try to ride the stock higher. But we were living in San Francisco at the time and looking for a house in a white-hot, notoriously expensive housing market. And she said if the stock reached $40, we'd be able to put that towards a down payment. Now remember, the stock was at $15, so she was planning on another 167% move on top of the 100% move the stock had just experienced. So I calmly reiterated my stance that this was a speculative stock and I'd prefer to sell half, reducing our risk. Now she had an excellent rebuttal. She challenged my manhood. So I'm still sitting there with 1,000 shares of Quacka and the stock starts to dip. So at $12, I said, when it gets back to 15, that's it, I'm selling for 100% gain. At $10, I said, if it just gets back to $12, I am out. When the stock fell to $7.50, I promised the trading gods that I wouldn't be greedy and I'd sell it at $10. At $5, I pleaded with those same trading gods to get me back to break even. At $2, I prayed it would get back to $5, and I rode this piece of all the way to zero. Losing $7,500 was a big hit to us. And though I enjoy painting my wife as the villain here, the truth is I could have and should have had an exit strategy in place. Now, the Oxford Club uses a 25% trailing stop on most positions. And unfortunately, I was not part of the Oxford Club at that time. Had I implemented a 25% trailing stop, I would have sold at $11.25, making $3,750 instead of losing $7,500. That's a swing of $11,250. Now, in our more speculative trading services, some of us, including me, tighten the stops as the profits increase, sometimes as tight as 10%. Now, had I done that, I would have gotten out with a $6,000 profit instead of a $7,500 loss. Now, the best feature of using stops is that they take the emotion out of the decision to sell because you add them when you're not emotional, not trying to rationalize why you should stay in and not defending your manhood. Now, if I had used a 25% trailing stop, I'd have had an additional $11,250. Now, if that money had been invested in the market for the next 21 years and earned the historical average of 8%, I'd have an additional $56,630, about the price for 1 year at a private university. And oh, by the way, I do have a kid in college right now. So I paid my tuition and didn't even get to do any of this. Have an exit strategy when you enter a position. It will save you a lot of money. For more wealth and income building tips, be sure to check out my free e-letter, Wealthy Retirement. Just click on the link below. I'm Mark Lichtenfeld. Thanks for watching State of the Market. I'll see you next week.